Welcome. I'm Pete Roth of Allen Matkins, and it's my pleasure to be here today at the 360 and 60 retail panel. To my right is Jeff Moore, Richard Rizika, and Dan Riley, and we'll be talking about Southern California and other regional retail developments. Jeff, why don't we start with you? We'll start at a global kind of 10,000 foot view. What are the major trends that you're tracking right now in retail?
There's a lot of interesting things going on in retail right now. I think one of the positive things is in 2013 was the first time since the pre-recession that we've had positive rent growth as well as positive net absorption. That's great news. We're still seeing globally, as you talk about macro, very strong luxury retail sales, especially in the gateway cities and on high streets, the prominent high streets, very strong. We're seeing value retailing continuing to be active and strong. We're seeing consolidation and activity in the supermarket industry, grocery industry, very interesting. Outlet malls, very strong part of the business. E-commerce is continuing to grow exponentially, about 5 times the growth rate of core retail, brick and mortar, and that will continue to be an interesting development in retail. And we're seeing retail stores continuing, retail chains continuing to adjust their footprint, and well as disposing of underperforming stores and consolidation in the industry. So,
great. Dan, keeping at the 10,000 foot level, with a little bit more support for retail now, how has that translated into sales transactions in the recent history, or things that are coming down the pike?
Well, volume has been tremendously on the rise. We had over kind of major transactions of larger type shopping centers. Nationwide, there was about a little over $60 billion worth of transactions. Here in Southern California, the more prestigious and high street type properties have been commanding some high prices. There was a Gucci building, for example, that sold not too recently on Rodeo Boulevard. Foreign investor, over $8,000 per square foot on the sales price, over $100 million for a single tenant asset. So that kind of set the high water mark. There's very few items out on the market now of the high street or larger type, 60 million and above type assets on the market. There are a few that have been sold over the last 12 months that have been somewhat off-market transactions. But overall, it's a very healthy investment market for retail, and both locally and international money and interests have been coming into California in particular, and it's really been helpful for us, and it's a great market going forward. We see probably in the next 12 to 16 months continued growth from where the rents may go for a number of our retailers that are in the centers that we have, from value add and then the high street. So things look good from the investment market. There's a number of centers that have been sitting idle, kind of just crawling along over the last couple of years, and now there's interest for people to jump in and acquire these assets and lease them up and come up with a new fresh look for them. And it's been exciting because we have our local investors, and we also have institutional, and then of course there's foreign investors. And we had a property actually out in El Monte, which was part of a bankruptcy sale. And at the end of the day, when it was going to close escrow, it was going to only be about 30% occupied. But it was a very strong intersection, had a great upside, tremendous ethnic grocer interest, and ultimately the highest price buyer for it happened to be a group of Chinese investors who also happened to have some experience in the grocery business. And so they reached far higher than anybody else, and we weren't sure where our highest buyer was going to come from, but that's an example of having open doors for international, local, and national type of money. And so I'm very bullish on where things are going to be heading for the next 24 months plus. I think that there's still a lot of upside opportunity for people that buy properties and add value, and then those with the stable high street type properties, they're just continuing to go on, and pride of ownership, and there are not as many of those coming on the market.
Excellent. Well, with that buoyancy, Rick, what are we seeing? What new developments are coming online or have been announced here in Southern California?
Well, there's actually quite a bit, which is really the first time since the Great Recession that we've really seen new developments. But there's some major developments that are ground up, such as the boulevards at South Bay and Carson, which is a development which includes both outlets and a major power center, and that offers over 2,500 feet of frontage on the 405 freeway. So an exceptional opportunity, but the first time we've really seen the outlets come together with a major power center here in Southern California. In addition, when we're talking about outlets, Steve Craig, Craig Realty Group, one of the preeminent outlet mall developers in the country, is developing a 70-acre campus, which will also be a major outlet center. But he's going to be sprinkling in some pad-type retail you might typically see in a promotional center. But he's got an exceptional opportunity there to go ahead and take everything from sweeping Pacific Ocean views to frontage on the 5 freeway. But it's those types of major developments right now which are not only bringing together, value retail, as Dan was discussing, but also going ahead and bringing more of the specialty retailers, and we're starting to see them kind of come together to create more unique shopping destinations. So those are a couple of examples of them. As we go up north, in Calabasas, there's a new development by Prime Store. That'll be another power center development. The tenants have not been announced yet, but a major development as well. Similar, we'll say, probably closer to 400,000 feet or larger when all is said and done. So you're starting to see projects like that, as well as the repositioning of major redevelopments. You're seeing most of the better regional malls throughout Southern California, their owners making a major reinvestment in those projects to make them more compelling and create greater attraction to their assets as well. And looking on developments to where you might find tired centers, especially in the urban infill markets. Examples would be Wayne Rakovich's block development, which is an old Macy's tired center from the 70s that's completely being transformed with a redevelopment of not only the shopping center, but the office building and the hospitality component as well.
Jeff, let's come back to you. You said some very interesting things in the overview, especially with regard to the changes that have been happening and coalescing even right now in the grocery area, as well as other big box retailers readjusting their formats and their floor size. Why don't you tell us a little bit about that?
Sure. Well, there's a lot going on both in the big box and the grocery industry, and I think they're two different questions in some ways, but the first one I think what's very interesting is what's happening in the grocery sector. We're seeing, I think, a lot of consolidation and a lot of activity. The world's changed dramatically from a decade ago when there were 3 major players in the grocery sector in Southern California. And now with 2 of them merging, Safeway and Albertsons, it's going to be interesting to see how the traditional sector of the market is going to shake out. And there's a lot of activity and competition from new brands and emerging brands that are very active. The niche players like Trader Joe's and Whole Foods, very active. The organic players, Fresh Market, Sprouts, Bristol Farms, active. The ethnic markets are active as well. El Super, Northgate Gonzalez, Cardenas Market, some of the Asian grocers. And then you've got the value-oriented grocers like Smart & Final and Aldi, which is coming into this market and a very strong player, and as well as Walmart with their neighborhood markets. So it's a very interesting, competitive market for the grocery sector. The OC Mix is an interesting concept. They're at their South Coast collection down in Costa Mesa. They just signed a deal down in Kaleidoscope. They've done a deal in Vegas, and they're going to the District in Tustin. And it's a 26,000 square foot concept where inside it's like a store, a number of stores within a larger store.
Yeah.
About 50.
Almost
a swap meet, but
swap
very
meet,
high.
but on a very high
end.
end, and I don't mean to downgrade by any means, but it's very interesting that you mentioned. I didn't mean to interrupt you, but go ahead on that.
Well, it's unique. What I was going to make is they're tailoring it to the shopping experience that has a flavor for that area. It's going to be theme oriented. It's going to cater to the cultures and the demographic of that area. So the type of retailers and what they do and sell inside, or the restaurants, will vary.
So that's a classic example of economic reuse of an empty box.
Great, and just sticking on this topic with the other big box, I know that for a long time, the Home Depots, the Costcos, those really big box superstores were expanding their footprints, and now it seems that they are refocusing on the particular neighborhoods that they're serving and their constituent marketplaces, and in readjusting some of those concepts. What's going on there?
Well, I think the big box industry is also a great topic. We've seen a constant evolution in that industry with not only right-sizing stores as they're trying to get their, they're trying to have cost efficiencies and operating efficiencies. Just it doesn't make sense to with the you have to have a brick and mortar strategy as well. It doesn't make sense to sell low margin commodity items, necessarily paying high rent on space. And you've seen chains that have gone away, and that space, their boxes have had to be absorbed. So it's a really, and I think just continuing on that, the last 3 or 4 years, there's been a lot of absorption of the boxes that did become available. I think in LA County, there's getting about 3 million square feet. There's been a couple million square feet in Orange County, another couple million square feet in the Inland Empire that have been absorbed in the big box space. And the vacancy rates, interestingly, in the big box space are actually lower than they are in the rest of the retail space.
That's a really good point, Jeff. When you talk about the absorption, we have had net positive absorption in the past 2 and 3 years in a few of the counties. Obviously, the outlying areas in the Inland Empire are still struggling to catch up with the coastal communities. But from the retailer's perspective, it's very interesting to see the productivity that we see in the first tier retailers versus the retailers that just have not traditionally been as efficient in those boxes in terms of their sales per square foot and their performance. So we're seeing tremendous difference even in the same market and sometimes even in the same shopping centers in terms of the rental rates from one box to the next. The players like Nordstrom Rack that can be twice as efficient in that space as their closest competitor, obviously have the ability to outpay and are often getting that first opportunity in the marketplace. You have strong players like Ross, who is also a very competitive retailer and very aggressive in their growth, and one of the leaders in terms of absorbing space in the box community. But their closest competitors can't seem to do the same volume and aren't paying the same rents per square foot. In the supermarket category, like you were talking about, there's been such a bifurcation. When you were talking about the 3 major retailers, at one point they each had close to 20, and Kroger having over 20% market share. But that's come down quite a bit as specialization has happened throughout the industry, whether it be ethnic, whether it be gourmet, whether it be, as you were saying, the new and upcoming organic environment is really causing an opportunity for the niche players to go ahead and to grow and further nibbling at the heels of the 3 former majors. By the 2 major players coming together of Safeway and the DBA of Albertsons under the SuperValu brand, you really have you see that Cerberus recognizes that in order to really compete, they had to grow and get a greater base to go ahead and to have a competitive advantage by competing in the middle.
It's a healthy change. You're right. It's a healthy change of certain retailers that if they don't adjust and move with how the market or their competitors are moving, and obviously the internet playing a part of it, and I know you had mentioned in previous discussions about people keeping an eye on how much Amazon grocery delivery might have some impact. Certain expansion plans would be put on pause. But at the same time, people are coming up with better ways to do business, and Staples having an adjustment in their store sizing is just a factor of that. I think that they realize they don't need as much showroom space to be able to deliver and do their online sales, and so it's going to be healthy all the way around for our industry. Obviously, there'll be some square footage that'll open up over time, But as proven from the recession, there's people, solid tenants that'll backfill that, and you're at the front lines of it.
You brought up a really good point, and that is that we always looked at Walmart as selling price, and all the other deep discount players. Right now, it's very hard for these major discounters to compete on price alone. So what they're really looking at are, I can sell service and I can sell selection, and by any new project, all the major developers are talking about trying to create an experiential opportunity, so that it's something that is a socialized community feel that you just don't typically get on the internet. And we're social beings, and we want to be with others, and we want to be in community. So you see that as a trend. But if you look just at what that means in terms of clearing out space, where you just have commodities, you really can shrink your format. And Wall Street is putting a lot of pressure on these major retailers to shrink their footprints and to be more efficient. But you're also hearing with Staples' announcement of what they're going to be doing in terms of shrinking, they're also going to go to more proprietary brands. And I think you'll start to see more and more that you'll see specialized brands where you can't get them on the internet, where it's the brand itself, the retailer is growing their brand by having these specialized products. And when you go shop at Forever 21, you're not going to typically be able to go on the internet and shop for that price unless it's through Forever 21 and they're doing fulfillment. So I think you see that same type of trend in the better brands, Columbia Sportswear, and so many others, where they have a brand, they have that where you can't go ahead and get that necessarily somewhere else. You have to get it through them.
So we're talking about on the products themselves, the differentiation and the specialization. So they're trying to avoid the commodity issue, which is what e-commerce is so good at. Thank you so much.
Okay.
Thank you.
Thank you.